Welcome back, everyone. Today, I'm going to revisit a topic I discussed about 6 months ago during COVID. That topic was about the looming commercial crash. Now, I said I predicted this to start happening around April, May, June, and lo and behold, we are right in the midst of a massive crash in the commercial real estate segment. Now, I'm going to go through a number of variables here, KPIs, metrics, that banks are talking about, the IMF is even talking about, Wall Street's talking about, and the question right now is being raised across Wall Street: do banks come out and just say, "Hey, this is what we're expecting the loss to be," or do they try to push it away and make sure that no one understands the looming risk that is ahead of us? And it's substantial. It's a I will say it's not as bad as I thought it was going to be. I was expecting about a 25 to 30% correction in commercial real estate. I don't think it'll be that severe, but it's not too far off. Okay, so here are some numbers, and I have it on my board here. So I'm going to go through some of these numbers, and it's concerning. And I got this idea to do this podcast on this one because I was reading The Economist, and I love The Economist. I read it every week, and if you don't read it, it's a fantastic journal to read, The Economist. And I found this article about the looming commercial crash. My prediction was spot on. And so here we go, right? Right now in May of 2021, 1 out of 20 buildings had occupancy rates above 10% in the United States. 1 out of 20, that's 5%. That basically means that while COVID is retreating, people are still staying home. And we're slowly getting back to normal. A lot of the tech firms are aiming for a July, August return. So that will obviously go up. But right now, there's still no use case for these office buildings. So a lot of workplaces are considering this hybrid model where they won't need big office spaces. They won't need all this, unique spacing now that is required due to the COVID. And so I think landlords are really exposed, not right now, but when it comes time to renew leases. At the very least, you're going to see prices come down in negotiations, right? And so let me tell you a few other things right now. Right now, the vacancy, so not occupancy. Right now, again, occupancy is 1 out of 20 buildings are above 10%. Vacancy, 1 out of 5 buildings have seen people leave the building and the space is vacant. It was between 2 to 5% pre-pandemic, right? So you're talking a 4x multiple on what it was pre-COVID. That's really important. Here's why that's important. If the vacancies remain at 5 to 8%, the valuations on commercial buildings will drop 15%. 15%. Right now, again, that's if the vacancy drops by 2/3 from today. Now, you can imagine if the vacancy stays up around 15, 20%, what that means for valuations. We very well may see 40, 50, 60% reduction in valuations. And you think about cities like New York or San Francisco that are heavily reliant on the tax revenues of commercial valuations. This is a frightening number to watch. So be sure to watch where commercial space vacancies are over the next 3 to 6 months, because I think you're going to see a lot of write-offs coming, and a lot of these banks that loaned to these organizations for these buildings, they're going to be in trouble. And by the way, if you're in REITs of commercial, make sure you're not in them. I would get out. I would hedge your bets. And if anything, I would be doing put options against those, because I don't see a good future for the next few quarters for these REITs. Okay, here's some other ones. Rents across the nation for commercial space on a square foot basis is down 10% across the nation. Now, in your bigger cities, it's obviously down a lot more. For example, San Francisco right now is seeing a 15 to 20% reduction in the cost to rent commercial space on a per square foot basis. Really not good. And you couple that with high tax policies, high regulations, anti-business environments. These states with or these cities with a lot of the these sort of policies are going to see massive exits, and they're going to see the impact from COVID. Double whammy, right? So you think about Seattle, you think about San Francisco, you think about LA, San Diego, New York, right? These are cities that I think are at real risk in the commercial segment. And then I think those are the big numbers to watch. Again, the IMF is expecting a massive correction, right? They come out and they said just in the last month that they expect valuations to come down substantially, and there is great financial risk in our economy. So what that means is if you're positioned in syndications that are focused on commercial office space, if you're positioned in REITs in your portfolio, if you own these properties, I would be considering right now to either exit those assets, sell those assets, or just stay clear until the everything is rebalanced back to where it should be. So again, a lot of risk in the commercial segment. You're seeing a lot of strength in the opposite, that being residential. And even with these new buildings with the zero net carbon, production and everything else in between, the hybrid model is here to stay, right? And Zoom, in their last earnings call, shows that the user growth is still skyrocketing. So people are adopting the hybrid model, and I don't think you're going to have the demand on office space as you once did. So again, I had to bring you this. It's a extremely important red flag that I see waving, and I did call it months ago. I'll put that video up here, and keep your eyes and ears to the ground, and I wish you all the best. Thank you.